What's up, everybody? My name is Keena, and I cover personal finance and investing. Did you know 9 out of 10 people think that rocket science is easier than determining the fair value to pay for a business? Okay, I did just completely make that statistic up, but it sounds plausible, right? I've noticed that intrinsic value and margin of safety are buzzwords that are constantly being thrown around, but very few of us actually know how to calculate and derive these figures. And personally, despite studying Warren Buffett and reading his role model Benjamin Graham's books over the years, until recently, I avoided ever learning, and I just kind of threw all of my money into index funds and called it a day. And while I still think this approach is best for most people, many of us want to pick individual stocks. My goal is to give you a full understanding of how to calculate fair or intrinsic value of a business, apply a margin of safety, and ultimately buy stocks with confidence. If this interests you, all I ask is that you give me your full undivided attention and stick around to the end of the video. Okay, let's get started. According to Warren Buffett, quote, "Intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments and businesses." And this makes sense. In order to place a value on a business or anything else, we first have to know what it's worth. Buffett goes on to say, intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of the business during its remaining life. Let's break this sentence down further. Discounted value of cash refers to the time value of money principle, which simply states that a dollar is worth more today than any time in the future. Think about it. If I offered you $100 today or $100 a year from now, which option would you choose? The smarter choice is to take the money today. And that's for two primary reasons. First, $100 will only have around $97 or $98 in buying power next year due to inflation. And second, because you could take that money today and put it to work, thereby earning you more money down the road. This is what Buffett means by discounted value of cash. We must discount the value of the money we receive in the future by a certain amount to take into account the fact that money decreases in value the further out into the future that we receive it. Let's look at the next part of the sentence, where Buffett refers to, quote, cash that can be taken out of a business during its remaining life. Conceptually, this is pretty simple. We just need to know how much profit the company will earn in the future. But in practice, this can get really tricky because correctly estimating growth rates, future sales, profitability, and ultimately cash flows can be more of an art than it is a science. And this is especially true as we get further and further out into the future. Generally speaking, the larger and more stable a company becomes, the easier it is to project future profitability and cash flows. And that means we can more confidently assign a fair value to the business. On the flip side, fair value calculations looking at smaller growth companies without multi-year histories of profitability are less likely to be accurate. All of this isn't to discourage us investors from calculating the fair value of an investment, but it does help shape our perspective so that we understand that the figure we arrive at is more of an estimate than an exact price figure. Even for large, stable companies, events like the recent pandemic can wildly impact business performance. And for these reasons, it's critical that we buy stocks with a margin of safety. Margin of safety refers to the concept of buying well below the fair price to ensure that even if we made errors in our calculations and the stock ends up being worth much less than we thought, we've still made a smart investment because we bought below the intrinsic price, as illustrated by this chart. Think of investing with a margin of safety as similar to waiting to buy a product on sale. It requires patience, but getting a bargain can be well worth it. Investors that follow Warren Buffett and Benjamin Graham's methodologies, show restraint, and buy with a margin of safety are typically referred to as value investors. Personally, I'm one of them. In this video, I'm going to give you an overview and a very simple example of how to calculate intrinsic value using Warren Buffett's preferred method by discounting future cash flows back to the present. I'll also link to a much more in-depth, step-by-step guide that I'm making using a real company as an example. So you can click up here if you really want to get into the weeds and try this out for yourself. I'll link again at the end of the video, so don't worry about not clicking now and missing it. If the link isn't there, just wait a couple of days. It'll be out shortly. Also, please smash the subscribe button below and click the bell so you get a notification when I post new videos. Let's go back to Buffett's quote for a second. In order to understand what he means by cash that can be taken out of a business, we need to cover two more concepts. The first is called owner's earnings. This term was invented by Warren Buffett and described in detail in his 1986 Berkshire Hathaway letter to shareholders, and refers to the actual physical cash that's left over after a business meets all of its financial obligations. Now, you might be thinking, isn't this what profit or net profit at the bottom of the income statement tells us? And the answer is not exactly, because there are many commonly used accounting techniques that impact profitability and disguise the amount of actual cash that's left over at the end of the year. Now, these are all legal and they follow generally accepted accounting principles, but they definitely add to the confusion surrounding intrinsic value. These techniques can broadly be described as non-cash adjustments to the income statement or as capital expenditures, which are expenses that aren't fully reflected on the income statement. Let me give you an example. Businesses often add a depreciation expense to their income statement, meaning that they add a non-cash charge to account for the loss in the value of an asset that they hold. Perhaps several years ago, a company bought a fleet of trucks for their employees, and they think that each vehicle will last a total of 15 years. So in each subsequent year after purchase, they add a non-cash depreciation charge equal to 1/15 of each truck's value to the income statement. At the end of each year, the net profit figure reflects this depreciation expense, despite the fact that no actual cash left the company's bank account during that period. Warren Buffett's owner's earnings figure accounts for these adjustments and derives the actual amount of cash that's left at the end of the year for the owners to use. Now, I'm not going to go deep into the calculation right now, but if you're interested, again, watch the next video in this series, which goes into far more detail. The last concept that we need to understand in order to calculate intrinsic value is called free cash flow. Now, free cash flow is almost identical to owner's earnings. What happened is that Buffett coined the term owner's earnings before publicly traded companies were required to publish what's called a statement of cash flows. He was just way ahead of his time. And in the late 1980s, when this requirement was added, the term free cash flow was used instead of owner's earnings. There's one slight difference between owner's earnings and free cash flow, but for now, just remember that these terms are basically interchangeable, and that also we can find free cash flow by looking at a business's statement of cash flows. We don't have to manually estimate and calculate this figure in the way that Buffett did before companies were required to disclose it. Okay, let's use a hypothetical example of a convenience store and calculate the intrinsic value for that business. In this case, it's a small store near the downtown that sells snacks and drinks, and let's say that we're trying to buy the store and we want to know what the correct price is to pay. The first thing we would do is enter a non-disclosure agreement, or NDA, with the owners and then gain access to their financial information. The table here shows free cash flow left at the end of each year for the past decade. This tells us the exact amount of cash that's left at the end of each year, and we just so happen to notice that it's been increasing by 10% each year. Because the growth just so happens to be stable and super consistent, it'll be very easy to project out cash flows into the future. So here's how that growth is likely to look over the next 10 years. And let's assume that at the end of 10 years, we expect that we can sell the general store for 10 times the free cash flow in the last year. I'm referring to that amount as the terminal value. The next step is to sum all of these numbers, and we arrive at a figure of $2,562,000. You might be tempted to just stop here and offer to pay $2.5 million to buy the business. But hold on, remember the conversation we had earlier about the time value of money? We need to apply a discount factor to account for the reality that cash flows that we receive in the later years of owning the store are worth much less than the ones we receive this year or next year. And they're less valuable because we're going to have to wait many years to receive them. So how do we determine the correct way to discount future cash flows to their present value? Well, there's a number of quantitative approaches, such as something called the weighted average cost of capital, but that's way out of scope for this video. In general, we just want to choose the rate of return that we could receive from our next best investment opportunity. So in this way, we're accounting for the opportunity cost. In this example, our next best option, if we don't end up buying the convenience store, is to invest the money in an S&P 500 index fund, which we expect will yield an 8% annualized return. And this is because there aren't any other businesses that are attractive to us at the moment. So if we don't buy the convenience store, we're just going to put the money into the stock market and forget about it. So we're going to calculate the present value of each of the future cash flows by discounting them back by 8%. We're also going to apply the same discount factor to the selling price, or terminal value, at the end of the 10-year period. Now, if we sum up all of these discounted cash flows, we can see that the present value of this business to us is about $1.36 million. Then when we get into negotiating with the owners, this is the price that I'd have in the back of my mind as the intrinsic value, assuming that I can turn around and use the cash instead to make an 8% annualized return in an S&P 500 index fund. I might also want to apply a margin of safety to the intrinsic value to account for unforeseen business risks. For example, if I think that the area where the convenience store is located is going downhill and maybe people are moving away, well, that's a risk to future cash flows. And I might want to add, say, a 40% margin of safety to this figure, meaning I'd only be willing to pay $816,000 to own the business. On the other hand, if I judge the business risks to be low, perhaps I'd just apply a 10% margin of safety, meaning the highest amount I'd be willing to pay to own the business is about $1.22 million. The goal, of course, would be to bargain the price down even lower, but I'd never buy at a price higher than the intrinsic value with a margin of safety applied to it. At the end of the day, determining what margin of safety to use is more art than science, and by looking at qualitative factors like the quality of management, competitive advantages, and industry trends, we come up with what percentage below intrinsic value we're comfortable buying at. Again, margin of safety is used to hedge against unforeseen business risks and also errors in our calculations. According to Benjamin Graham, quote, "The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future." I think this sums it up well. So to summarize, determining the fair price to pay for a business is a two-step process. First, we calculate the intrinsic value, and then we apply a margin of safety to that figure based on our own opinion as to the riskiness of the company in question. When we're done, we arrive at an exact dollar value for what we're willing to pay. The main difference between the example above and doing this for a publicly traded company on the stock market is that we'd be looking to buy shares instead of the entire business. So in that case, we just need to account for this by dividing the final number we get for intrinsic value by the number of outstanding shares, since we'd only be buying a small fraction of ownership. And then, of course, after doing this, we'd apply a margin of safety. If you're interested in doing this for publicly traded companies, click here for an in-depth guide. If you don't see that video linked, again, just give it a day or two and I'll post it. If you found anything in this video useful, please consider subscribing, and thank you. I'll see you all in the next one.